It's time for the Trading Stocks Made Easy podcast. Each week, Trading Stocks Made Easy demystifies stock trading and investing so you can profit big. And now, here's the host of Trading Stocks Made Easy, the wealthy investor, Tyrone Jackson.
Hey, it's Tyrone Jackson, the wealthy investor, and I see you're back for more. You can't stay away from the Trading Stocks Made Easy podcast, and boy, do I appreciate that. Okay, I'm always talking to you about your mindset and your beliefs, and you can do very well in the stock market. Well, one of the reasons that your mindset and your beliefs about what is possible turn into cash, it's because you have the right financial education. Who around you in your circle is financially educated? See, we choose a lot of people around us who've been to great schools or universities or who are well-versed on certain topics, and that's wonderful. But are they well-versed on becoming a stock market millionaire? Well, if you don't have any of those friends around you, you've come to the right place. So today's episode is called What's Up with Disney Stock? So I always say don't buy the stock if you don't understand the story. Now, first, I want to start off by saying I love the Walt Disney Company. I love what they stand for. I think they do fantastic things in the world. But today we're going to talk about the stock specifically and what's going on with the company. Now, obviously, I can't go through everything here, but I just want you to see the power of the right education matched with buying, selling, trading, and investing can be very lucrative. Let's get started. The question that I want to pose to you today, because some of you are Disney shareholders, over the last 5 years, Disney's share price has gone from approximately $99 to where it is at the time of the recording to $111. Now, that's the stock performance over a 5-year period. Of course, there have been ups and downs, peaks and valleys, right? Right. In the same 5-year period, if you look at a company like Costco, ticker symbol COST, 5 years ago, Costco shares were trading at around $199. And at the time of this recording, they're at $514. Now, you don't have to be a mathematical whiz to know that the shares have gone up at least 100%. I can bring in 7 stocks that have done the same thing over the last 5 years. They've all increased 100%. Now, why is that exciting and what does that initially mean to you? Well, it means if you were good at picking stocks that tend to double in 5 years, you could take $10,000 and just by holding the stock, it would turn into $20,000, right? $100,000 invested would turn into $200,000. Well, if you started out with a $200,000 investment, in a 5-year period, $200,000 turns into $400,000. Okay? So learning how to invest money instead of just giving it away to someone, well, really important. But what if you can pick stocks that had a tendency to double for the rest of your life? Meaning every 5 years, 80 to 90% of the stocks that you choose to invest in, they all double. Well, you would be a genius, right? Okay. So people sometimes say to me, you're really good at this stock market game and picking stocks that are able to go up 100%. And I say thank you, but I'm really just following a formula. Now, I'm not trying to minimize my skill set, and I'm not trying to sit here and portray false humility. I am good at what I do, but it's only because I am well studied. And that's what I teach my students, how to pick winners. It's almost like people who date. And are very good on dates and have successful relationships. Well, they're good at it. Not everybody is good at being married or being in a relationship. I happen to be very good at picking stocks and then being able to explain to you how the market works so that you can pick winners too. Okay? So that's the premise of what's going on here. So Disney stock 5 years ago, around $99, currently $111. Costco stock at $199, but currently trading at $500, a 100%, over 100% return, right? Okay, so in order to understand why some stocks move forward and others don't, I always say don't buy the stock if you don't understand the story. So here's what's going on at Disney. Disney makes a lot of its money, its revenue, from its catalog. Television shows, movies, motion pictures, and we know that Disney has now gotten into deals with companies like Marvel, right? And so that they can partner and make even bigger films. So traditionally, Disney has made its money off of its television and movie catalog and licensing. So let me explain this to you. Once Disney made a movie like Mary Poppins, right? It's not only the production cost in that movie. If that movie, let's say, cost back then $1 million, how much will that movie make in licensing fees to other TV stations around the world who want to exhibit the movie in theaters, et cetera, et cetera? Well, it's probably made over its lifetime $100 million. So was Mary Poppins, the motion picture, worth the $1 million that Disney put up to produce it? Well, the other stream that's connected to movie and TV shows is also called merchandising, right? The dresses, the hats, the characters, right? The memorabilia from the film. That has an aftermarket value, okay? So if we added in the merchandising on Mary Poppins, over time, I'm sure it is made more than $1 million. You get the idea, right? So Disney has done this over and over and over again, and they've been really successful. Up next are their theme parks. So Disney makes an awful lot of money at letting people into the theme parks. Now, let's think about the revenue from the theme parks. It's not just the entrance fee. It's also the merchandising. If they can control their merchandising while you're in the park, that becomes another $100 million in revenue, right? They can also have a spinoff in the form of cartoons, et cetera, et cetera. But those theme parks are really important because they get you to, in effect, interact with the Disney brand, fall in love with the characters. It's a great experience. Now, while you're at Disney, right, you might actually get hungry. For those of you who've been to Disney World and you've gotten hungry in the park, right, the food ain't cheap, right? So they've got all these secondary ways of generating revenue, right? And by the way, because I have 2 daughters and they used to love to go to Disney when they were younger, right? Just the bottled water alone at Disney is expensive. And isn't it interesting that their parks are in all these sunny areas, right? So they've really thought through the whole process. Well, Disney formed a partnership back in the 50s and 60s with the ABC television network so that its movies and TV shows, once they produced them, they automatically had distribution on ABC. Okay? Now, as time has gone on, Disney ultimately bought the television network, which is the ABC television network. So they were in charge of distributing their shows as well as the other shows, and they've made billions and billions of dollars doing that. All of a sudden, a little something called streaming comes along, and a company called Netflix says, hey, can we license the Disney catalog? And Disney goes, well, we don't know anything about this streaming because all our movies are on television or in theaters. But if we can make residual income from $2 to $3 billion a year, why not do that? Because we don't know anything about this streaming thing, and I don't even know if this company will be around. So yeah, we'll take your $2 to $3 billion. Netflix said thank you, and then Disney's catalog was on a streaming service. Now you got to understand how the big boys really play this game. When there's a new form of media, they don't want to be a part of it. They want to own it. So Disney and Netflix come to a conclusion that Disney is going to pull its catalog from Netflix and start its own streaming service. Now, I don't want to speculate, but I think probably somebody made an offer to buy something. And I don't think Netflix made an offer to buy Disney, but it may have gone the other way around. It didn't work out. And Disney goes, well, we'll start our own streaming service. Now, let me tell you something about streaming. It's the new frontier for those bigger companies because of that Apple phone, and we're all watching movies on our phones, iPads, and anywhere around the world. No big company is going to let one company like Netflix own that space. Don't buy the stock if you don't understand the story. Are you getting the lesson? Okay, so Disney pulls its catalog from Netflix, takes the $2 to $3 billion that they were being paid to launch their own service, which they conveniently decided would be called Disney Plus. And all of their content would go to streaming. Well, You, as an investor, are supposed to be reading these quarterly reports that come out that tell you where Disney makes its money. Why? It's a publicly traded company. They have to release the reports to shareholders if they want to remain publicly traded. If you read the last report, apparently Disney Plus has not worked out too well. It's caused the company for the first time in its history to lose $4 billion. So what do they do to offset that? They raise, which is in the report, this is public information, they raise the price at the theme park to offset the loss on Disney Plus so they wouldn't upset Disney shareholders. Well, individual stock owners like you and I, after reading that report, says, well, wait a minute. If you're losing money on the streaming services and people are buying your stock because the revenue is rising, well, isn't this loss going to hurt your bottom line, your net profits? The answer is yes. So what are you guys going to do about that? Well, the first thing is we're going to fire the new CEO that we thought was going to lead us through this entire digital revolution. You know, how people view things. Yeah, get rid of him. So they get rid of him. They bring back Bob Iger, the old guy who's tremendously smart, gifted, wonderful man, caring, understands through and through what the Disney brand is all about. And they say, hey, under your leadership, we got to kind of fix this because we can't keep this $4 billion loss thing going on. So this is an ongoing story. Now, this is what you have to understand. When educated investors read that report, they're not going to buy more shares. Why? Because there's a $4 billion loss on the bottom line. We're supposed to be buying into companies or dating companies that have net revenue on the bottom line as well as growing revenue on the top line. That's part of the success formula for picking really good stocks. But when your stock is not performing according to that rubric, shareholders tend to sell it off. Do you get it? So you're not going to get a stock price that doubles if on the bottom line there are $4 billion in losses. So Disney has quite a set of circumstances on its hand. Well, in order to build this streaming service, you have to build the infrastructure. Now, let me explain this to you. You know how when you're watching something online and a video you're really into, and all of a sudden it starts buffering? Fortunately, we don't see too much of that anymore. Well, to get that signal through requires a lot of bandwidth so that video flows with a certain degree of fluidity. Well, Disney underestimated the cost in infrastructure to get that picture out to you and all of their 200 million subscribers. So they're paying an awful lot of money in hosting fees and broadband costs to bring you their Disney catalog. You see, this is where it gets really interesting because Netflix is essentially a technology company. They can anticipate the cost of broadband and how those costs are going to rise over time in relationship to subscription dollars, right? So you have to make sure that you're bringing in enough subscriptions to cover all those rising technological costs, as well as bring in brand new content because the consumer these days likes a catalog, but they don't love it. They want fresh new material. So bringing in content specifically for your streaming service is going to cost you at least these days another $1 billion. Because if you want high-end content, where are you going to go? You're going to go to Hollywood, people who create movies and TV shows that have done really well. Well, that talent, both in front of and behind the camera, costs money. Is the picture starting to get a little clear to you? Right. So you just can't ride in on a horse and say, we're the big guys, we've got the talent and the directors, because a lot of the big people that you want, they've already signed to who? Netflix. Oh, in a free marketplace, producers sign contracts to the people who give them the best deal, not only financially, but also creatively, so they can tell the stories that they want to tell. Remember, I'm explaining to you why the stock price went from 99 to 111 over a 5-year period, while other stocks in the market have gone up 100%. Now, Disney also has another problem on his hands, and that is called an activist shareholder. An activist shareholder is someone who holds a large amount of Disney stock, millions and millions and millions of shares, and they don't like what's going on inside the company. Well, did you know if you own enough shares, you can get the attention of the board of directors, and you can start demanding things like meetings, discussions, telephone discussions, because you don't like what's going on in the company. So the shareholder with the largest shares becomes the boss of the company. Well, right now, there is an activist shareholder who wants a seat on the board of directors. Now, the board of directors makes policy for a publicly traded company or any kind of company. And really, in the world of corporate world, there are really two types of boards. You can have an advisory board. Hey, let's give you some advice on how to run this company. Or a board that makes policy. So the board that makes policy is always the most powerful. And if you're an activist investor, what do you want? A seat on that policy board so you can change things around from the inside. More of what's going on with Disney stock right after this.
Want to increase your stock market trading profits? Then you need to start your monthly membership to WITradeschool.com right now. Don't understand how to write covered calls for monthly income? No problem. Simply review Tyrone's latest stock trades in our video library as many times as you need. WITradeschool.com is all about helping you get the financial education you need to earn money in the stock market and change your financial life. Tyrone Jackson, the wealthy investor, has helped his students earn thousands of dollars per month trading stocks online from home. These are people just like you. So what are you waiting for? Follow Tyrone Jackson's red-hot stock trades and investment strategies today. Don't wait. Start your monthly membership at WITradeschool.com right now.
Hey, it's Tyrone Jackson, Wealthy Investor again, and I just wanted to remind you that if you enjoy listening to the Trading Stocks Made Easy podcast, be sure to share it with your friends all across social media, including Facebook, Instagram, and Twitter. If you enjoy hearing about success principles that inspire you, as well as interviews with some of my most successful students, I want to remind you it's right here at the Trading Stocks Made Easy podcast, wherever you get your podcast. And make sure you download as much free material as you want at thewealthyinvestor.net. I'll see you there. What is up with Disney stock? Okay, this is so good. I want to get right back to where we are. So, if we have an activist shareholder who's trying to get a seat on the board to change policy, he could flip, if he got on the board, he could actually flip other people on the board more towards his perspective. Now you've upset the board, you've changed policy, and maybe you won't have a Disney Plus streaming service if it's losing or contributing to the loss to the tune of $4 billion. Because activist shareholders want the bottom line to increase. For those of you who are worrying about the bottom line so much, and why am I talking about the bottom line? Because that's where your dividend comes from. So if you cut the dividend, you're taking income away from the shareholder, your stock becomes less appealing. Now, as I said at the beginning of the show, I love the Walt Disney Company, everything that they stand for, their imagery, but they do have a problem on their hands. I'm not describing to you anything that isn't public. Now, if all of this is going on at Disney, that pressure to produce a profit on the bottom line is not going to cause the share price to rise, right? So if we're choosing with our money right now to put our money in stock prices where there's no activist shareholder, there is no $4 billion loss, and there is no streaming service, what are you going to do? Well, you're going to put your money in the stock that has the greatest probability of going up 100%, right? Right. Now, that is what is up with Disney shares, is they're under a lot of pressure right now. So I'm wishing Bob Iger and the gang all the best. Why? Because they really have to fix what's going on over there. They have a great brand with no dividend on the stock, and Wall Street is simply, generally speaking, not going to buy more shares. Disney has also had a problem over the last 5 to 7 years with ESPN, right? So ESPN also wasn't profitable. So if you add ESPN on top of that, because they own ESPN, if you add ESPN mixed in the cauldron with Disney Plus, there are a lot of divisions that are kind of like struggling. Where they're not struggling is in the real estate business. I know we think of Disney as a theme park and a wonderful destination. It's really a real estate play. How many acres does Disney actually own, right? Really, if you think about it, they're charging you access to acres upon acres upon acres, right? And they have entertainment on that acreage. For those of you who own land or a house on land, if you were going to make money in real estate, how do you do that? You rent out your home, right? And that's essentially the business model for Disneyland, is you're charging access every day for people to come into your world and be entertained, but you still own all that real estate. And here's what we know. Real estate goes up in value. Why? They're not making any more land. So Disney is sitting on billions of dollars in real estate, and they do very well when they started to build hotels. Because, think about it from their point of view, if you're coming to visit the attraction on my land and I can charge you per night for food, drinks, and lodging, I just created hundreds of billions of dollars in additional revenue. Why? Once you build the hotel, you don't have to rebuild it. You just have to keep it in great condition. And if you stayed in our hotels and we gave you priority access to the park, look at how many ways we are extracting dollars from the consumer who loves our brand. As my father used to say, that's a profit. Okay, so we love Disney's business model, but this streaming service, along with ESPN, well, bringing down the company, and it's not making the stock price rise. However, if I'm a covered call writer and Disney's stock price doesn't rise, Disney becomes an income source for me as a trader. If I know how to use spreads, in particular bear call spreads, I can exploit the stock because it's not moving by selling time, setting up one strike next to another, letting them expire, doing that again over and over and over again. So there are some traders who love Disney stock because it's not rising, so they can set up spreads. Those people who bought shares years ago, they can get paid residual income by selling out of the money covered calls. So it's a matter of perspective, right? As I always say, the stock market is one game and 100 ways to play it. How do you want to play it right now if you're currently a shareholder? It's up to you, but you have to have that financial education and the skill so that the trade that you're going to put on against Disney shares is a constant revenue generator. And that's why I love teaching. Because it doesn't matter whether a stock goes up, goes down, or stays the same. If you understand the story and what's causing a stock to pause, you can make thousands and thousands of dollars off the fact that the stock is not advancing. However, if you have limited skills in the stock market, you just want all your stocks to go up. You don't care about the hundreds of thousands of dollars that you may be able to generate because the stock doesn't move. So, for some of you, it's time to upgrade your skills so that you're just not relying on the stock price rising as your primary source of participating in the stock market. It doesn't have to be that way. It doesn't have to be that way. It doesn't have to be that way. But you do need to learn how to become a better trader and investor. So, I thought in this episode I'd pick Disney because it's a company that I love, but whose stock price is struggling because of a myriad of issues that surround the marketplace and that they are entrenched in. So here's what I think needs to happen to Disney. They're going to need to sell a stake in somebody else, a piece of Disney Plus, so they can get their money back, and they're going to have to get movies back in theaters instead of just streaming. Why? Because Disney has had several $750 million weekends at the box office, and you only get that when you are, when you are selling tickets to people. And when you sell tickets to movies, you want as many sales as possible, right? What sells millions of sales? Well, when mom has to pay, dad has to pay, and the kids have to pay, there are 4 or 5 ticket sales there. And we know if you've ever taken a child to the movie theater, you got to buy the popcorn, the candy, etc. That business model is going to have to come back. Now, remember, I was the first one to tell you that I think we're going to be back in the movies within a year watching big blockbuster films, but they won't tell us it's because of revenue. They'll say, we realize that there's certain experiences of movie watching that you just can't get at home, and our films are best viewed on the big screen. Oh, you need the money, in other words. You need the ticket sales back, right? Okay, so I give it 12 months or less, and we'll all be, because COVID is over, we'll all be going back into the movies because the people who make the movies need those ticket sales. As Jack Nicholson said in A Few Good Men, you want me on that wall. You need me on that wall. I was actually just looking for an excuse to throw that in. Anyway, that is what's up with Disney stock. I hope this is helpful because every publicly traded company has a board of directors it has to answer to and powerful activist shareholders who they have to answer to as well. You may not have enough to be an activist shareholder, but pay attention to where you're putting your money and pay attention to the revenues and the issues that are surrounding the companies that you're trading and investing in. And guess what? That'll make you a better stock market trader and investor. I'll see you next week. When? Right here on Trading Stocks Made Easy. Tyrone Jackson, always wishing you well.
You've been listening to the Trading Stocks Made Easy podcast. Be sure to rate and review our show on iTunes. While you're on iTunes, be sure to click the subscribe button and you'll automatically receive our next episode.